Hello students, welcome to the lecture on capital structure management, and after the completion we will be able to learn the following objectives. Understand the capital structure management, discuss about capitalization, describe theories of capital structure management and explain cost of capital. Capital structure management. Let us start with capital structure. Capital structure is the proportion of debt, preference and equity capitals in the total financing of the firm's assets. The capital structure of a company refers to a contamination of the long-term finances used by the firm. The capital structure decision influences the value of the firm through its cost of capital and can affect the share of the earnings that pertain to the equity shareholders. The capital structure involves two decisions. Types of securities to be issued are equity shares, preference shares, and long-term borrowings. Relative ratio of securities can be determined by process of capital gearing. On this basis, the companies are divided into two. Highly geared companies. Those companies whose proportion of equity capitalization is small. Low geared companies. Those companies whose equity capital dominates total capitalization. Factors determining capital structure. There are some factors which determine the capital structure. Trading on equity. Trading on equity becomes more important when expectations of shareholders are high. It refers to additional profits that equity shareholders earn because of issuance of debentures and preference shares. Degree of control. In a company, it is the directors who are so-called elected representatives of equity shareholders. Flexibility of financial plan. In an enterprise, the capital structure should be such that there are both contractions as well as relaxation in plans. Debentures and loans can be refunded back as the time requires. Choice of investors. A capital structure should give enough choice to all kind of investors to invest. Capital market condition. In the lifetime of the company, the market price of the shares has got an important influence. Period of financing. When company wants to raise finance for short period, it goes for loans from banks and other institutions, while for long period, it goes for issue of shares and debentures. Cost of financing. In a capital structure, the company has to look to the factor of cost when securities are raised. Stability of sales. An established business which has a growing market and high sales turnover, the company is in position to meet fixed commitments. Sizes of a company. The bigger the size, the wider is total capitalization. Internal factors affecting capital structure management. The internal factors which are affecting capital structure are cost of capital. While planning the capital structure, it should be ensured that the use of the capital should be capable of earning the revenue enough to meet the cost of capital. Risk factor. In financial terms, risk and return always go hand in hand. Whichever capital is cheap for the company is risky for the future company. Control factor. While planning the capital structure, and more particularly while raising additional funds, the control factor plays an important role, especially in case of closely held private limited companies. Objects of capital structure planning. While planning the capital structure, the following objects of the capital structure planning come into play. To maximize the profits of the owners of the company, to issue the securities which are easily transferable, to issue the further securities in such a way that the value of shareholding of the present owners is not affected. External factors affecting capital structure management. The external factors which affect the capital structure management are general economic conditions. While planning the capital structure, the company needs to consider the general conditions existing in the economy. Behavior of interest rates. While planning the capital structure, the company may be required to take into consideration the likely behavior of interest rates in the economy. Policy of the lending institutions. If the policy of the lending banks or financial institutions is too harsh or rigid, it will be advisable not to go for borrowed funds. Taxation policy. Taxation policy as a factor affecting the capital structure decisions needs to be reviewed from the angle of the company as well as the investor. Statutory restrictions. The statutory restrictions prescribed by the government and various other statutes are required to be taken into consideration before the capital structure is planned by the company. General factors affecting capital structure management. The general factors affecting capital structure management are constitution of company. While deciding about the capital structure, the constitution of the company plays an important role. Characteristics of company. Characteristics of the company in terms of size, age and credit standing play a very important role in deciding capital structure. Stability of earnings. If the sales and earnings of the company are not likely to be stable enough over a period of time and are likely to be subject to wide fluctuation, the risk factor plays more important role and the company may not be able to have more borrowed capital in its capital structure as it carries more risk. Attitude of the management. If the attitude of the management is too conservative, the control factor may play an important role in capital structure decision. Capitalization. Capitalization comprises of share capital, debentures, loans, free reserves, etc. Capitalization represents permanent investment in companies excluding long-term loans. Capitalization is generally found to be of following types: normal, over, under. Overcapitalization. Overcapitalization is a situation in which actual profits of a company are not sufficient enough to pay interest on debentures, on loans and pay dividends on shares over a period of time. Causes of overcapitalization are high promotion cost, purchase of assets at higher prices, a company's flotation and boom period, inadequate provision for depreciation, liberal dividend policy, overestimation of earnings. Effects of overcapitalization on shareholders. Since the profitability decreases, the rate of earning of shareholders also decreases. On company, because of low profitability, reputation of company is lowered. On public, an overcapitalized company has got many adverse effects on the public. Return on capital employed is low. This gives an impression to the public that their financial resources are not utilized properly. Undercapitalization. An undercapitalized company is one which incurs exceptionally high profits as compared to industry. An undercapitalized company situation arises when the estimated earnings are very low as compared to actual profits. Causes of undercapitalization are low promotion costs, purchase of assets at deflated rates, conservative dividend policy, flotation of company in depression stage, high efficiency of directors, adequate provision of depreciation, large secret reserves are maintained. Effects of undercapitalization on shareholders. Company's profitability increases, market value of share rises, financial reputation also increases. Shareholders can expect a high dividend. On company, with greater earnings, reputation becomes strong. Higher rate of earnings attract competition in market. Demand of workers may rise because of high profits. On society, with high earnings, high profitability, high market price of shares, there can be unhealthy speculation in stock market. Secret reserves are maintained by the company, which can result in paying lower taxes to government. Theories of capital structure management. There are 4 basic capital structure theories. They are net income approach, net operating income approach, Modigliani-Miller approach, and traditional approach. Net income approach. Net income theory was introduced by David Durand. According to this approach, the capital structure decision is relevant to the valuation of the firm. Assumptions of NI approach. There are no taxes, the cost of debt is less than the cost of equity, the use of debt does not change the risk perception of the investors. Algebraically, the relationship between the cost of equity, cost of overall capital and debt equity ratio are explained as follows. KE is equal to KO plus in brackets KO minus KI bracket close B upon S. KE cost of share issuance, K capital cost and T tax. Net operating income approach. Net operating income approach was also suggested by Durand. This approach is of the opposite view of net income approach. This approach suggests that the capital structure of decision of a firm is irrelevant and that any change in the leverage or debt will not result in a change in the total value of the firm as well as the market price of its shares. Features of NOI approach. At all degrees of leverage, debt, the overall capitalization rate would remain constant. Value of equity is equal to total value of the firm minus value of debt. Cost of equity increases with every increase in debt and the weighted average cost of capital WACC remains constant. Modigliani-Miller approach. It favors the net operating income approach and agrees with the fact that the cost of capital is independent of the degree of leverage and at any mix of debt equity proportions. Basic propositions of approach. At any degree of leverage, the company's overall cost of capital KO and the value of the firm V remains constant. The cost of capital KE equals the capitalization rate of a pure equity stream and a premium for financial risk. The minimum cutoff rate for the purpose of capital investments is fully independent of the way in which a project is financed. Assumptions of approach. Capital markets are perfect. All investors have the same expectation of the company's net operating income for the purpose of evaluating the value of the firm. Within similar operating environments, the business risk is equal among all firms. 100% dividend payout ratio. An assumption of no taxes was there earlier, which has been removed. Traditional approach. Traditional approach stands in the midway between net income theory and net operating income theory. This theory was advocated by financial experts Esther Solomon and Fred Weston. According to this theory, a proper and right combination of debt and equity will always lead to market value enhancement of the firm. According to this approach, an optimum capital structure does exist. Market value of the firm can be increased and average cost of capital can be reduced through a prudent manipulation of leverage. The cost of debt capital increases if debts are increased beyond a definite limit. Cost of capital. Capital refers to the funds invested in a business. The capital can come from different sources such as equity shares, preference shares and debt. All capital have a cost. Cost of capital may be defined as the company's cost of collecting funds. This is equal to the average rate of return that an investor in a company will expect for providing funds. It was defined by many. Hampton J. The cost of capital may be defined as the rate of return the firm requires from investment in order to increase the value of the firm in the marketplace. James C. Van Horn. The cost of capital is a cut-off rate for the allocation of capital to investments of projects. It is the rate of return on a project that will leave unchanged the market price of the stock. Solomon Ezra. Cost of capital is the minimum required rate of earnings or the cut-off rate of capital expenditure. There are three basic aspects of the concept of cost of capital. Not a cost as such. It is the minimum rate of return. It comprises three components. K is equal to RO plus B plus F, where K is equal to cost of capital, RO is equal to return at zero risk level, B is equal to premium for business risk, which refers to the variability in operating profit EBIT due to change in sales. F is equal to premium for financial risk, which is related to the pattern of capital structure. Importance of cost of capital. The cost of capital is very important in financial management and plays a crucial role in the following areas. Capital budgeting decisions. The cost of capital is used for discounting cash flows under net present value method for investment proposals. Capital structure decisions. An optimal capital is that structure at which the value of the firm is maximum and cost of capital is the lowest. Evaluation of final performance. Cost of capital is used to evaluate the financial performance of top management. Other financial decisions. Cost of capital is also useful in making such other financial decisions as dividend policy, capitalization of profits, making the right issue, etc. Classification of cost of capital. Cost of capital can be classified as follows: historical cost and future cost. Historical costs are booked costs relating to the past, while future costs are estimated costs act as guide for estimation of future costs. Specific costs and composite costs. Specific cost is the cost of a specific source of capital, while composite cost is combined cost of various sources of capital. Explicit and implicit cost. Explicit cost of any source of finance is the discount rate which equates the present value of cash inflows with the present value of cash outflows. Implicit cost, also known as the opportunity cost, is the opportunity foregone in order to take up a particular project. Average cost and marginal cost. An average cost is the combined cost or weighted average cost of various sources of capital. Marginal cost refers to the average cost of capital of new or additional funds required by a firm. Cost of debt capital. Cost of debt is the main method of cost of capital in finance and financial management. Cost of debt is calculated on the debt, bonds, loan or debentures by multiplying interest rate with given amount of debt. Cost of preference capital. Costs of preference capital are also used to calculate the cost of capital and are the fixed cost bearing securities. In this, the rate of dividend is fixed in advance when they are issued. Cost of equity capital. Its main motive is to enable the management, which is to make the decisions in the best interest of the equity holders. There are various approaches for computing the cost of equity capital. They are the SML approach or CAPM model. According to the SML, the cost of equity capital is KE is equal to KRF plus beta in bracket KM minus KRF. Bond yield plus risk premium approach. In this approach, a judgmental risk premium to the observed yield on the long-term bonds of the firm is added to get the cost of equity. Cost of equity is equal to yield on long-term bonds plus risk premium. Cost of retained earnings. Cost of retained earnings have the opportunity cost associated with it, and it can be computed as well without any difficulty. Re-retention is equal to retained earnings upon net income. Retained earnings refer to the portion of net income or loss that is retained by a company rather than distributed to its owners as dividends. Weighted average cost of capital. The weighted average cost of capital, WACC, because the cost of capital that should be used in evaluating projects is the marginal cost of the funds raised to finance the project, and the WACC is considered to be the best estimate of marginal cost. WACC can be calculated using the following formula. WACC is equal to KEG bracket open E upon bracket open E plus T bracket close plus KD bracket open 1 minus T bracket close bracket open D upon bracket open E plus T bracket close, where KEG is equal to the cost of equity in the geared company, KD is equal to the cost of debt before tax relief, E is equal to the market value of the company's equity, D is equal to the market value of the company's debt, T is equal to the rate of corporation tax applicable to the company. Summary. Now in the end, let us summarize what we have learnt in this lecture. The term capital structure refers to the percentage of capital, money at work in a business by type. Overcapitalization is a situation in which actual profits of a company are not sufficient enough to pay interest on debentures, on loans, and pay dividends on shares over a period of time. The value of the firm is more in the case of lesser overall cost of capital due to more application of leverage in the capital structure. The cost of capital may be defined as the rate of return the firm requires from investment in order to increase the value of the firm in the marketplace.